And we are live. Ladies and gentlemen, welcome to the Dylan Holy Experience midweek market recap. More specifically, it's Christmas week. Stuff's getting toasty. The Christmas rally is in full swing. Let's just go straight into it. Stock futures rise on Wednesday evening. Stock futures rose slightly in overnight trading on Wednesday after better than feared earnings and strong consumer confidence data helped boost stocks for a day. And we will most definitely be talking about the consumer confidence data later on in the Dylan Holy Experience. Stock futures tied to the Dow Jones Industrial Averages gained 38 points or 0.1%, while S&P 500 futures added 0.15%. NASDAQ 100 futures inched 0.12% higher. Micron Technology shares dipped 2% in overnight trading on disappointing quarterly results, and we're going to break down that Micron earnings report a little bit later. The overnight moves followed another positive session for stocks. During regular trading Wednesday, the Dow gained 526.74 points, while the S&P 500 and NASDAQ Composite surged 1.49% and 1.54% respectively. All 11 S&P 500 sectors finished the day with gains, led to the upside by energy. Woo! Dude, I'm telling you, man, this Christmas rally, regardless of what happens macro with the markets and everything, I think that we probably have further downside, and there's some information that we're gonna take a look at later on in the stream that helps give some legitimacy to that thesis. But nah, man, there's just something about that Christmas week rally, dude. The thing is even with all of the high inflation, even with, the consumer confidence is up, but overall it's still relatively low. But dude, this is the best week in terms of profit bookings for companies each year. Q4 and specifically Christmas week is just a massive rally. So yeah, it's, you know what? There is upward action, and my portfolios are definitely in the green today, overall macro. So I guess that's a good thing. Good stuff. I'm all about it. Cool. But don't let this deter you from the fact that, macro long term, there's a lot of pressures that are trying to force downward action on the market. And this also isn't a doom and gloom. I'm not saying the entire market's going to tank. We're going to enter a new Great Depression. Again, I don't really know. Macro long term, and here's the biggest secret. No one really does. No one really knows what's going to happen in the markets. I definitely think if you look at it from a macro perspective, we've come out of quite literally the market cycle that we came out of last year was called the everything bubble. The everything bubble. That's what it was called. So the good vibrations can't go on indefinitely, man. So I definitely think that there's going to be some downward action. Again, this Christmas rally is in full swing. But one of those things that is contributing to that downward action, in my humble opinion, and this just keeps getting worse month to month. Home sales tumbled more than 7% in November. So month over month, buyer demand is down 7%. It is the 10th straight month of home declines. And sales were down 35.4% year over year, marking the 10th straight month of monthly declines. So, dude, there are for every 3 buyers there were last year. For a home, there's only 2 now. That being said, median sales still rose 3.5% to $370,700 from a year ago. So home prices are still going up. But here's the other thing too. This stuff is lagging. So, and I know I keep saying that, and it has a lagging effect, and wait for the physics to catch up. I know I say that ad nauseum. Also, everyone in the chat, just I've been having issues recently with audio stuff, so I'm just gonna we're just gonna take a look. All right, it looks like the microphone is still hot, which is absolutely fantastic. I was just making sure. There we go. So again, I know I say it ad nauseum about wait for the physics to catch up, but stuff is slowing down. Like the real estate market and the home market specifically within the real estate market, there were a lot of things that were causing downward pressure. And also, if you take a look, the actual home builder sentiment, so not just people who are purchasing homes, but home builder sentiment drops for the 12th straight month. They are saying a bottom may be near. So like that's more of an op-ed. Keep in mind, like most everything is an op-ed. The Dylan Ollie experience is an op-ed. It's my opinion on the market. No, like it's no advice. I try to look more at the facts, but that's what they all say. So maybe I sound just like him. Home builder sentiment dropped for the 12th straight month to the lowest level since 2012. So this was right when home sales and home purchase volume started kicking back up after the financial crisis. Like this is, I mean, people started buying homes, coming into like 2010, but this is when it started when it started moving up again and actually snowballing up to the positive side in terms of like rampant home purchasing. About 62% of builders are using incentives to bolster sales, including providing mortgage rate buydowns, paying points for buyers, and offering price reductions. So it's not just the fact that home builders, there's less of them actually developing parts of or just homes in general, but then you take a look at the lumber pricing. So look at this lumber pricing, man. If we take a look at the monthly, it's down. They don't really give us a percentage. Man, NASDAQ, y'all dude, just give me a percentage. We're gonna have to bust out the calculator. Again, there's nothing wrong with busting out the calculator. I am just saying that just add a percentage in there. It's so much easier. Okay, so it was 435 at its previous month, or at its previous highest within the last month, and right now it's trading at $377.99. $377.99. All right, so it's a downfall of 430 or 57.01, and then we take a look. All right. So over the last month, the price of lumber, at least lumber futures, so paper contracts of lumber, are down 13%. If we actually take a look even further, from an all-time high, and this was in May of 2021. So last year, it was like this was basically at the most overheated the market like ever was. Like I think this was like a few months after GameStop. S&P 500 was in the midst of returning 21%, having a 21% 2021 fiscal year. So, and this was at the peak of that, just like complete buyer euphoria right here. So from that point, lumber futures were trading at $1,480. And we subtract that to where we are right now, 376. That leaves us with a difference of 1,104 points. And then we divide that by 1,480, which was the previous all-time high. Lumber. The price of lumber from the highest it has ever been to the hardest the market has ever moved to the upside in history. The month that like basically ended it all, or that was like at the peak of that in terms of like buyer volume. From that point to now, the price of lumber is down 74.5%. Let me show you where I got that number. You just multiply that by 100, boom, 74.5%. That's how much lumber is down. So we are back to a pre-COVID level. The last time it was this cheap was 2019. The last time lumber was this cheap was 2019. In October of 2019, if you want to get more specific. So there's way less demand. But in terms of buyer demand, and this isn't just for homes or stocks, but it's also for like everyday commodities. So, things like gasoline, things like food. At least what is being told to us from CNBC, and albeit it's fair enough if you want to give yourself that, but the U.S. consumer confidence, which is basically this monthly report details consumers' attitudes, buying intentions, vacation plans, and consumer expectations for inflation, stock prices, and interest rates. So this is basically given like do people think that stuff's going to get cheaper and their stocks are going to go up? Or do people think that stuff's going to get more expensive and their stocks are going to go down? That's really what this is. We can take a look. So the consumer confidence is still it's still somewhat down from its highest it ever was, but what they're telling us is this is the best it has been since April, since the pre-Russo-Ukrainian conflict. This is the best it's been since April, and it's most certainly better than what 2009 is looking like. But again, I think that there's still probably some more downward action that's going to happen. I think stocks are going to cool off a little more. I don't think that's a crazy thing to say. I think that the markets are going to cool down a little more. I mean, again, not this is, I do not set out to try to like chart and show and people be like, all right, I'm going to take a position here. It's never been about that. I'm not a trader, but I am someone who macro, I like to look at things. And if, charts could be interesting, it definitely puts into perspective like what historical trends have been in terms of their means and averages and everything. So it's just something to look at. It's still like basically finance bro astrology. Like the market tends to act independently of these variables. So it's still just market astrology. But, it seems like if you start looking at the 2 week, it does look like stuff is still in the green. It's still showing that like we are, in terms of the purchasing strength, it's still showing that we are better than the 2 week average here on the relative strength index. But I don't know, man. There's just too much stuff at play. Like stuff is cooling down. Like the actual reason that there were two main reasons that homes were being bought up like hotcakes. And it was the fact that we were in basically the lowest interest rate environment we've ever been in, basically like the greatest time for credit markets in American history. We were at that point, and on top of that, the price of everything in terms of like commodities, and now, it's now being, I guess it's not slowly anymore, but it's being realized that like inflation takes hold. But in terms of just like the sheer demand, because everything was shut down and there was no supply, went through the roof. So that's why lumber was being traded at, $1,480, at least lumber contracts. If we take a look at this, but if you look at like the historical average, I mean, like it's relatively low, like it typically like it's somewhat stable. Like it's predictable, at least for the last like 9 years or so. But you also like, it's also all about context. Like we can look back 9 years later and be like, yeah, it's fine. But again, this period right here is an anomaly. This has never happened before. This type of price action. Then it crashed back down, and boom. So if you're looking at the consumer confidence, it's still down from where it was, from its highest point ever, but it's not the lowest it has been, at least within the last 16 years. This is not the lowest it's been, and we could go lower. You really never know. I think we might. I think people are probably going to think things are going to get worse, and will continue to think that things are going to get worse, because I think things, at least from what drives people to say like this is what makes the economy bad, like I think that credit markets are going to get further tightened. The Federal Open Market Committee said that they were going to bump interest rates. We talked about this last week. Let's just take a look. I know we already spoke about this last week, and everyone generally knows that the Fed is going to bump interest rates, but they're going to bring it to 5.1% by the end of this year, which basically means like right now we are sitting at, and it's going to tell us, basically sitting at a targeted range between 4.25% to 4.5%. So I think, and we can actually take a look at the 10-year bond if y'all want to get freaky with it. Let's look at the 10-year bond. Bada boom, US 10Y. Okay, yeah, so it's at about 3.655% today. So, like, again, bond yields are fun too, but overall, like, you can see that bonds have been increased by this federal basis point raise. Come on, man. Okay, let's just run it back. But nonetheless, even to what the Fed is saying, they're going to bump interest rates by another percentage point through next year. So stuff is going to get even tighter, and like the cooling and contraction mechanics that the Fed is introducing into the markets are going to catch up really, really hard. And they're going to do what they set out to do, and that's cool stuff down, contract stuff, put it back in check, bring the prime inflation rate to 2%. I still think that's BS. But you do you, Fed, you do you. But they're looking to bring it back to 2%. And right now it is at like 7% still. So I think stuff's going to catch up a lot. And this isn't just the U.S. doing this. If we take a look over to our friends in Southeast Asia, or I guess it's not Southeast Asia, but just like in East Asia, the Bank of Japan. Let's say benchmark rate rise causing the yen to surge. The Bank of Japan says 10-year government bond yields can go as high as 0.5%, up from the previous cap of 20 or of 0.25%. Basically, what's going on? So how Japan works, how Japan's central bank works. Japan's central bank. We can just let's just go back. So if we take a look at the Bank of Japan, or the central bank of Japan, what they basically do is they set like a maximum of what interest rates can go to, but that doesn't mean that's not what the current interest rate is. Like there was a defined maximum of 0.25% in Japan, because Japan's economy has stagnated so drastically. Like people who say like, that's xenophobic, Dylan, you can't say their economy has stagnated. Their economy is stagnated. I think like generally most economists can say that like Japan's economy has stagnated, but because Japan like massively industrialized in like the 70s through the 90s, and then they entered a cooling period. And like if you look at the Nikkei 225, like, oh, it doesn't even go back that far. Come on, man. All right, let's just run it back even further. Let's see if CNBC can give us what we need. There we go. All right. If you look at the Nikkei 225, it basically, so it peaked at $38,915. $38,915. And at this point, where its peak was in 2021, it peaked at $29,453. So it never like its economy has never regained the heights that it did in like the early 80s and 19 or in the late 80s, excuse me, 1989. So they kept these interest rates low because they wanted to like spur lending and investment and like having low interest rates tends to incentivize people in investing and being more loose with their money. That's just how humans are. Like the whole system is debt based. So when you make the debt easier to be taken advantage of, then like people do that. Not in terms of like doing illegal stuff. I'm just saying like in terms of people being able to access credit. As soon as credit gets easier to access, people take on as much credit as they can. Like that's just how human nature is. So Bank of Japan, they previously had the cap set at interest rates can only go as high as a 0.25% in the positive. Like that's basically like a 0.25% is their hardest core monetary policy. And now they raised it to 0.5%. So it's not saying that interest rates are going to 0.5% in Japan right now, but the Bank of Japan has now basically given precedent that you can raise interest rates basically double as high as what they could go to. It is still 0.5%, and at least in America, at least in the United States of America, the interest rates are higher. But this is a very, very interesting play by Japan, because if you also take a look at what's happening to the yen, at least in terms of the parity between that and the US dollar, let's take a look. It is higher than it has been in the past. Like at its lowest point, it was very, very devalued, and at its lowest point, it's now double from where it was. Or it peaked double from where it was, but even right now, like it's now double where it was from its lowest point. So for every yen that you purchased or that you had in like 2011 against the US dollar, the world reserve currency, it's worth double in value. So, like they're trying to bring power back to the yen. That's what they're trying to do. And like again, even if you look at it from like the early 70s, it's definitely still devalued macro, but they're trying to slow stuff down. This is just macro conservative monetary policy and macro interest rate rising. That's just happening right now. That is just happening right now. If we take a step back, because I actually didn't address this, I went over it. Semiconductor maker Micron announces 10% staff reduction and suspends bonuses. Semiconductor maker Micron announced it would reduce its headcount by about 10% in 2023 in the latest example of a technology industry slowdown affecting employment. If we take a look at the actual earnings per share, or loss per share, oh man, no. Okay, so they were estimated to only lose 1 penny per share, but they actually lost 4 pennies. So they lost 4 cents per share. They underperformed by about, I think like negative 300%. Unfortunate, but it's okay. So it's all right, Micron. Let's take a look at the revenues of the $4.1 billion estimated. They only earned $4.09 billion in revenue. So yeah, I mean, this is just part of a further tech slowdown. And I understand them laying off parts of their staff, but also like the bloat isn't just there. Like it's also at the executive level and at the shareholder level. I mean, not shareholder in terms of like, everyday people holding Micron. I'm talking about like the insiders and all the people working in the executive positions at Micron. Like, I don't think they're taking a pay cut, but I think they suspended bonuses, but not base salary. And they just, and they laid off 10% of their workforce. I definitely think that there is overall corporate bloat. There is like corporate America is bloated right now. We came out of a period in history basically from 1 year ago, where like it was the most bloated the market had ever been. So it has to shave off and get rid of some of that fat. It sucks that people are losing their jobs and their positions and careers to the 10% of people that of the staff at Micron that was laid off. Of course, best of luck in all your future endeavors. Y'all are working at Micron. Y'all are gonna just be able to go to another company. Y'all are like fucking royalty. STEM. Whew. Yeah, so best of luck to you all. Y'all got it in the bag. Don't even sweat. All right. Let's take a look at what's going on in the petroleum world. There was actually a pretty big set of stuff that was going on within the last week, basically from the last midweek market recap to this one. But if we take a look, this happened on Friday. Joe Biden has announced new actions to rebuild and strengthen U.S. energy security and the Strategic Petroleum Reserve as a whole. Are they going to break it down here? Nah, they're not going to. Let's not read it from the White House. Let's get rid of that. Let's just take a look at CNBC, because they did a pretty good job of condensing it down. There we go. They have introduced a plan to buy back oil for the Strategic Petroleum Reserve. If we take a look, they are looking to start purchasing. Yeah, the White House said in October it would buy back oil for the SPR, or the Strategic Petroleum Reserve, when prices were at or about $67 to $72 per barrel, a bit below where U.S. benchmark futures were trading on Friday at about $75. So if we take a look, it's getting close to where the U.S. is going to start trying to replenish the strategic or the SPR. If we're going off of Brent, no, I think we go off of West Texas Intermediate crude oil. That's what we go off of, baby. Not that Brent Euro stuff. West Texas Intermediate. So if we take a look here, after Biden said that, it was sitting at like right about $74, $75. Now it's back up to $78. So they actually haven't started purchasing petroleum yet. They have not made purchases, or at least from what they say, there could be like background deals and back office deals. I can't comment on any of that. I don't know the validity of those statements, but at least from what they're telling us, they have not purchased any oil yet. And here's what's interesting. CEO of Saudi Aramco, the largest oil company on planet Earth that we know of, says, quote, "The world should be worried. The global oil market remains tight, according to Saudi Aramco, the largest oil producer in the world, and that does not bode well for a world that still heavily relies on fossil fuels. Quote, today, there is spare capacity that is extremely low," end quote. Saudi Aramco CEO Amin Nasser said at a recent conference in London, quote, "If China opens up the economy, starts improving, or the aviation industry starts asking for more jet fuel, you will erode this spare capacity," end quote. Nasser warns that oil prices could quickly spike again. Quote, when you erode that spare capacity, the world should be worried. There will be no space for any hiccup, any interruption, any unforeseen events anywhere around the world," end quote. And then they start talking about oil companies to invest in. ExxonMobil, Chevron. Just for transparency purposes, I do own Chevron and ExxonMobil in my brokerage accounts. So I personally own them, not financial advice on if you should or should not. But they're saying, at least on Yahoo, that these are some energy companies to look at. Man, I like the companies. I think they have a good business model. Anyway, so CEO of Saudi Aramco is saying, like, now that, because, dude, China is just coming out of zero COVID policy lockdown. So shit's about to really start opening up in China again. And, well, basically, the West has completely cut off Russia from trading with them. So and OPEC, they're probably going to side closer with Russia because they also have oil drills and are net importers. Wait, net importers? think it's net. Is Saudi? I think Saudi Arabia is a net. It's a net exporter because that means that they do more. Let's see. U.S. poised to become net exporter of oil. Yeah. So Saudi Arabia is sending more stuff out than they're sending in, and I think that they want to start keeping some of that, especially if like they see that like how much these Western European countries and the United States are taking their oil and basically being like, we don't want your oil, so they might stop giving it to them, and they'd be more likely to give it to a reopened China. That, dude, there are 1.3 billion people in China. I might even be wrong. They might even be at 1.5 billion. Let's see. 1.412 billion people. Yeah, there's 1.4 billion people in China. That are all going to start using just mega petroleum-based products again. And India is at 1.393 billion people. Wait till they start fully industrializing. Like, they are in the process of an industrial an industrial revolution right now in terms of like modernizing their markets and industry and everything. And they're going to start using more oil. So I think there may be another oil crisis. Again, we are coming out of at least like a micro glut. I definitely think like over the long term, oil companies, I think that they will trend up. I think that like we will like people talk about like, oh, we need to get rid of gasoline based vehicles and gasoline based cars. Okay, that's fine. We can get rid of it. Lithium mining is just as devastating and detrimental to the environment as petroleum drilling, if not more. And make it and please have it be noted that I do own the largest lithium mining company in the entire world, and I also own the company that has the drilling rights to the largest lithium deposit in the United States. So I own SQM, Sociedad Química y Minera, and Lithium Americas Corporation. So I definitely think like there will be like I'm also going to own a Tesla. Like I'm going to own a Cybertruck. I love the Cybertruck. So I am like pro EV car, but they're not as clean as people are saying. So I definitely think if we run it back even further, the amount of petroleum that is used on gasoline is only like 10% of all oil drilled. It's used for that. It's only used for 10%. 10% of it is used for gasoline, but there's another 90% of it. If you take a look at basically like any product that you have in front of you, it's basically petroleum based. If there are any plastics in there made by like a multi-billion-dollar corporation, it is all petroleum based. 90%. 90%. So let's see how much petroleum or percentage of petroleum used for plastics. Plastics production, 4%. All right, let's see global oil production. Oil production use. Oil production use by industry. Let's take a look at that. Let's see what's going on. Use of all. Okay. So motor gasoline is 44% of it. Wait, no, is this? Oh, that's just source. Distillate, but they're just talking about like straight oil. That being said, I still think like, okay. Even if gasoline is more is like more significant to the use of US based petroleum products, getting rid, like, there was going to be a lot of pushback in terms of people getting rid of these gasoline based cars, and it's just prohibiting the sale of gasoline based cars. Which, okay, yeah, get rid of gasoline, but there's also, going to be the energy sector. Burning it for energy, like, listen, we can make all of this investment into a green future, and that's fine. Like, your green future is okay. That's cool. Let's go for it. I mean, like, I'm invested into rare earth companies that are going to be supplying these chips. I also own NextEra Energy, which they are the largest green energy producer in the United States and pay a fantastic dividend. I do like NextEra Energy. Obviously bias and not financial advice, but I do have transparency in showing you what I own. So, I definitely think that, like, if demand starts actually increasing for oil, because it doesn't seem like it's going to be going down anytime soon. We're making steady moves towards it, but nothing super significant. And basically one major population superpower, that being India, is massively industrializing and will start using more petroleum. And on top of that, you have China opening back up from a zero COVID policy lockdown, like basically just opening its doors. COVID's over for them now, and the production stays the same or drops, or China just starts buying up all of it because they still have free trade with Russia and these OPEC producing countries and nations, and the West doesn't get any of it. I think oil could spike, but there's also an extremely low capacity because of those countries still adhering to COVID guidelines a little bit. But let's move away from the oil topic. Let's go to just the broad stock market. So typically, most people, or a decent amount of them, use these things called target date funds, which are basically market indexes. Let's actually just take a look here. Target date funds. Let's just get a visual. Yeah. So if you take a look, you basically invest into it's an index fund that's like semi-passively managed. They only do like major rebalances like at the end of each year, and it's like a broad market thing. So at first they have you when you were younger broadly invested into more volatile risk-on assets such as stocks, and then in these index funds they also have some exposure to bonds. And then over time, as you get older, you get more exposure to bonds, less exposure to stocks. And then you also get like short-term bonds, stuff like that. And then there's those long-term bonds as well. And then you just get even, you just get more conservative over time. So one of the major mechanics for these index funds to operate is something called a rebalancing, a portfolio rebalancing that thing. And it's basically taking like all of the money they basically in your tax advantaged accounts. And this is like a very gross understatement or gross simplification. But you start for every like $10 that you put in, $4 of it would go into bonds, and then $6 of it would go into stocks. Now, let's say the stocks grow, and then that portfolio is now 70% bond or stock dominant and 30% bond dominant. At the end of the year, all of the money that's in that account, you basically sell some of your stocks for more bonds, and you're not really getting like a taxable event in there. Like, it's done automatically, and you don't really pay tax on it. It's not even like an active event. But in the back end, that's what happens. And you sell some of the stocks, and then you buy some more bonds to bring you back to, for every $6 invest or every $10 invested, 6 goes into stocks, 4 goes into bonds. Now, because those stocks are no longer owned by people in most cases, because bonds, stocks are still more valuable than bonds in terms of those markets. $100 billion of stock was just sold on portfolio rebalancing purposes. So these portfolios getting rebalanced, and obviously like the dollar amount invested into the US stock market, dollars invested into US stock market. Market cap of US stock market. That'll work. Yeah, market cap of US stock market. $46 trillion. Like, obviously, $100 billion is nothing compared to 46 trillion. But there still was some downward action there. Like, I don't think whatever is sold here, I don't know if that's going to like really impact the independent macro movements of the market. But it is something to look at. Stuff is getting rebalanced right now, but it would also be like, next year bonds sold for stocks, or like $100 billion of bonds were sold for stock. So again, I'm going to keep dollar cost averaging into what I'm doing right now. I have 10% of my 401k in bonds. I have 90% in the S&P 500. I have the S&P 500 in my Roth IRA. So I'm definitely like, whatever happens long term really makes no difference to me. With the, like this headline, it makes no difference to me. So to end it off tonight, and it's just another episode in the reality TV show that is Donald Trump. But they did make some of his tax returns public today. And the number that got me the most was in 2020. It shows his tax returns show a negative income of $4.69 million with $0 in taxable income. The tax paid by the Trumps was $0, and they claimed a tax refund. The Trumps claimed a tax refund of $5.47 million in 2020. So, yeah, I mean, like, again, I'm not surprised that he took advantage of the system. Like, everyone knew that he probably took advantage of the system in some way or another. And whether that's a good thing or a bad thing, taking advantage of the IRS and those loopholes, some can make the argument that it should be closed. And I think that there could be a compelling argument made for that. But, Donald Trump doing this, sure, it's messed up. But, like, all of the top 1% does it, dude. Dude, I'm sure, the author of this article probably did the same loopholes that Donald Trump did. Like, they all do it. So this understanding of moral righteousness with, like, what Donald Trump did was wrong. He shouldn't be doing it. They all do it. So either, like, there should be a scrutiny placed on all of these federal public officials, including presidents, including senators, including representatives. I mean, shit, dude, AOC is being investigated by the House Ethics Department right now. Sometimes it's a whole nothing burger, but sometimes it's not a nothing burger. So again, like, I guess it's good that they published Donald Trump's tax returns. But dude, there are another like 535 members in the legislative or in the legislative branch alone that need to have this same level of scrutiny placed on them. I'm sure Trump was quite happy with that $5.47 million tax refund. Who knows what he ended up doing with that? But I don't know. Like, yeah, I guess have scrutiny on Trump, but you need to have scrutiny on everyone. Like, it's not just Donald Trump isn't the only thing that's wrong with the U.S. government. And Trump isn't the only person who probably does these loopholes. And with that, I think we took care of everything, baby. We took care of everything on Christmas week. Let's go into our quintessential plug. Twitter.com @RealDylanHoly. We always post those Twitch updates saying when we're going to go live with the Dylan Holy Experience and the midweek market recap at that. We always do key takeaways on every single business day. The market is the the traditional markets are open. Sometimes we talk about some Destiny stuff. I mean, it's just news. We cover all kinds of news. Obviously, no financial advice. I'm just giving you facts of stuff that has undeniably happened. So we have market updates, just pieces of info, stuff that you're seeing right now. I give to you the information that I'm telling you right now. I put it up 8 hours before on Twitter. So if you want some breaking news, at Real Dylan Holley on Twitter. Of course, the mediums upon which you are watching me right now, we have youtube.com/@DylanHolley. Of course, be sure to subscribe there, and twitch.tv/RealDMH. Feel free to follow. I don't have a sub button yet. I don't have a donate button. I mean, I guess I do have a donation button here. Subtle plug. But ladies and gentlemen, that's it. That's all that we have. Thank you to the millions for tuning in. It's much appreciated. I love getting to do this for y'all. I hope you all have a Merry Christmas, Kwanzaa, to all my Judaism practicing brethren and sistren, and I guess X. I just non-binary. If you don't identify as masculine or feminine pronouns, any Judaism practicing person, I hope you all had a fantastic Hanukkah. You have a fantastic rest of your evening, and I will see you next week on the Midweek Market Recap.